have the famous Rob Chrisman. We are very honored to have him here today. Such an important individual for our industry, keeping us informed on a daily basis and with humor as well, which I very much enjoy. So I wanted to take a few seconds and just let you all know that we are recording this, and if you're members, we will have that on our audio library on our website. So be sure to check that out. We will be speaking and having some questions here, Rob and I, but then if you have any questions, please be sure to put them in the chat box, and we will try to get them as well towards the end of the session. So I'm going to give a brief bio on Rob. I think everyone knows Rob. That's why you're all here today and know again how important he is. But Rob Chrisman began his career in mortgage banking back in the capital markets in 1985 with First California Mortgage. Am I correct?
1902.
Not quite that. You were assisted in secondary market until 1988, and he joined Tuttle and Company. Back in then 1996, he moved to Scotland with his family for 9 months. Why did you do that, by the way, for just 9 months?
Oh, my wife, Julie, at the time, worked for Hewlett Packard, and Hewlett Packard had a manufacturing plant in or near Edinburgh, and Julie's accounting skill set was such that they needed somebody there for a project. So off we went. I was Mr. Mom. Great.
I bet. I bet it was wonderful, wonderful. Well, you did return to the United States, thank goodness, in 1997, and then you ran the secondary secondary department and marketing for Standard Financial, which was, again, a subprime lender in Northern California. I bet that was fun in those times. In 1997, Rob was hired by Crossland Mortgage to start and to be the president of subprime company named
On-Call Mortgage.
On-Call Mortgage. Our paths might have crossed over that time because I actually ran a branch here in Fort Myers for Crossland Mortgage several years ago. So we never know. Rob then joined CMG Mortgage. It's a wholesale mortgage bank at the first as director of secondary marketing in early 2003, and then joined Tuttle Risk Management Services. Rob is on the board of directors of Inheritance Funding Corporation, a financial services company, which enhances capital to heirs of Doorway Home Loans, which is of AXIS Appraisal Management and the California MBA. He's also a member of the Seattle Secure Settlement Advisory Board, an associate of Stratmore Group and the Mortgage Bankers Association of the Carolinas. Rob has been providing our expert daily Rob Chrisman Mortgage Daily news for a number of years now. And he holds also a bachelor's from Cal Poly San Luis
Obispo.
There we go. And on an MBA from US Berkeley. So I'm sorry if I butchered a little bit of that. I'm in a room where I don't have a lot of light here. So that's all right. Well, thank you, Rob, again for joining us. And I am just going to open the door and have you take it away.
Well, thank you. Yeah, we have all kinds of things to talk about. And I think we've got a small enough group, and you guys probably all know each other. I recognize some of those names on the screen, but this is informal. So if I'm saying something and you think I'm all wet or totally wrong, please don't hesitate to yell out. And I know Linda has some time saved for questions afterward. But I think when you've been in the business for a while, Linda, I do want to talk to you about your Crossland days, because I remember a significant presence in Florida. But throughout the mortgage industry's decades, it always seems like we overcome these hurdles or speed bumps or whatever you might want to call them, whether it was the Great Recession, or whether it was higher interest rates, or whether it was the CFPB or TRID or the new IRLA, or Mark Calabria heading up the FHFA. No matter what's going on, we as an industry tend to say, okay, and figure it out and move forward and help our borrowers. And I think that obviously brokers play a huge role in that, because the broker community has really thrived here recently. And I'll take a quick step back. I remember back in 2011, 2012, 2014, in there, I would receive emails from brokers, and they would say, you know, hey, here's my resume, you know, whatever. But Rob, do you think that the CFPB is wants to see the broker go away? And I would reply, I don't think that the CFPB has painted a target on brokers' backs. And in fact, I think that if you are originating loans in a compliant manner and have good customer service and a minimum of consumer complaints, the CFPB couldn't care less about doing really anything to the broker channel. And sure enough, the brokers have survived, and as I said, thrived. Your market share has moved higher. And I think that's due to a couple different reasons. First off, I think that every broker shop and every broker is in effect running your own small business or big business, depending on the size, but we're all business people. And there are a lot of smart business people in the broker channel. And so you've got that going for you. The second thing is you have, you have deep roots in the community. People ask me, gee, are originators going to be replaced by computers? And is the industry going to go the way of making a Southwest airplane reservation? And I always say no, because it's not the internet, Linda, that is sitting next to other parents in the bleachers watching their kids' soccer game. And it's not somebody, not to pick on anybody in particular, but it's not somebody up in Detroit who's sitting there at church with other people in the pews. The brokers have a very deep seated attachment to the community that they serve, and they are the ones putting signs on the Little League fence. And they are the ones sponsoring, hot dogs, between halves at the soccer match and so forth. So the broker community has shown that it is a force to be reckoned with and should continue to do so. Now, getting back to my initial comments about we as an industry tend to do well and continue to help the consumer no matter what's thrown our way, I firmly believe that. And there's always, I kind of chuckle sarcastically, I guess, a little bit when people say, oh, there's a lot of uncertainty. We don't know what's going to happen. And, boy, I don't know what's going to happen with interest rates, or I don't know what's going to happen with Fannie Mae and Freddie Mac, and I don't know what's going to happen with Mark Calabria, and I don't know, blah, 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 blah. Not to dismiss that, but there's always uncertainty that we as an industry are dealing with. And we always do okay with the things that are thrown at us. So, I'll probably talk about interest rates today. I don't exactly know what Linda's going to throw my way or what we're going to talk about, but I imagine the economy is part of that, and interest rates, Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are such a big part of our industry. For a while there were people who thought they were going to go away. I was receiving emails. Where are we going to sell our loans if Fannie Mae and Freddie Mac go away? Well, they're not going anywhere. What are we going to do if FHA gets shut down? Well, FHA is not going to be shut down, and so forth. So on top of that, you guys are dealing with these big nationwide issues, and at the same time dealing with the Jones loan and the Smith loan and trying to hire a processor, or gee, my office manager is going on vacation and I don't know what we're going to do for 2 weeks, and those kind of issues. So those are issues that you are dealing with in addition to the big issues that everybody's facing across the nation. So it's an interesting combination. It's an interesting situation that brokers across the nation find themselves in. is dealing with these global issues, dealing with the U.S. economy, dealing with Fannie Mae and Freddie Mac, and trying to keep track of all that, and then trying to keep track of, gee, do we just have everybody work from home and do away with our lease, or do we bring people back into our office? I mean, micro questions like that. So, and there's always a lot going on in our industry. Now, Fannie Mae and Freddie Mac have been in conservatorship since the Eisenhower administration, or so it seems. No, they've been in conservatorship for several years now, and for a while there was a lot of talk about getting both of them out of conservatorship. They don't deserve to be, or they shouldn't be part of the U.S. government as much as they are. That talk has quieted down a little bit, but Mark Calabria, when you listen to him speak, and I listened to him yesterday speak about the things that he has done and the things that he wants to do with regard to Fannie Mae and Freddie Mac, his mindset, and you have to keep this in mind when you hear about news from Fannie Mae and Freddie Mac, but his mindset is to recapitalize them, i.e. have them make more money, have them keep more of the money that they're making, and shrink their footprint, especially when it comes to risk. So the latest, that we can talk about, we'll talk about Fannie Mae and Freddie Mac, I'm sure, in a little bit here. But when you hear about their decisions and things that he says, keep that in mind. His goal is to get them out of conservatorship, and to do that, they need money. And to make money, they need to charge things like the adverse market fee or high guarantee fees, or put caps on what they view as riskier products like second homes or non-owner occupied home loans. And so, and when you talk about the change that they're going to make in July with regard to doing away with buying QM patch loans, it's all a set in the context of risk and profits. So we've got that going on as an industry. And of course, the things that Fannie Mae and Freddie Mac do impact other investors. So how will what they do with regard to capping the window sales from for lenders at each investor at $1.5 billion for the year, how does that impact other outlets? How does that impact investment banks? How does that impact the non-QM lenders? How does that impact the execution, and in turn the pricing, which impacts borrowers? So it has a ripple effect. The things that they do, the things that the FHA does, and HUD does, and Ginnie Mae do or does, also has a ripple effect. So we've got these big agency decisions that are being made that sift down through the Wells Fargos, the AmeriHomes, and the Loan Depots, and the Plazas, and the United Wholesales, and the Freedoms, and Rocket, and Quick, and so forth. So it's this huge interconnected spider web of spider web is when, you have a spider web and a fly lands on one edge of the spider web and starts to try to get loose, and it vibrates throughout the whole thing, and then the spider, of course, comes out and wraps it neatly in its web and has food for a week. When a change is made in our industry, it does have this, it does shake the whole spider web of our industry, from the big investment banks all the way down through the large aggregators, PennyMac and AmeriHome, Wells Fargo, down to brokers and down to individual, one-person shops in the broker community. So, and credit unions and banks and mortgage banks, we're all linked. So you'll always hear people talk about uncertainty. You'll always talk about, what about this and what about that? And many of the things that we tend to worry about, of course, don't end up happening, which is a good thing. But I think it's important for people on the call to remind your coworkers that, we'll get through this. A new 1003, what a pain in the neck. Every day I get emails from people complaining about the new 1003. And I was talking to some people yesterday, and they were like, yeah, we're okay with it. Yeah, those questions should be asked. We're okay with it. It's not a big deal to us. So we as an industry continue to move forward regardless of what's thrown our way and regardless of interest rates, which I'll take the opportunity now to talk a little bit about, because interest rates do impact and have a direct impact on our market and our volumes and our margins and so forth. And when you talk about interest rates, it's important to keep those in perspective, because what's going on in the US and world economy impact the rates that your borrowers pay. Um, and when you see what happened, a year, 13, 14 months ago with the pandemic and the way the market reacted and the way the Federal Reserve reacted, and suddenly rates moved down, and they've stayed down, but you had all these ramifications that happened because of the pandemic, which nobody predicted. And so, I kind of chuckle again about people who say, oh, well, you need to lock because rates are going up, or don't lock because rates are going down, or we expect, GDP to do this and personal income to do that. Well, keep in mind, nobody has a crystal ball. Nobody can accurately forecast where rates are going to go. I will say this, and you can tell your clients this: the inclination is for rates to move higher. Well, why would rates move higher? Because the economy is starting to pick up a little, hopefully, post-pandemic momentum. And when the economy is doing well, rates tend to drift higher. How much higher? Most of the experts think not much higher than where they are now. I'll tell you this, my daughter locked in a home loan rate on the West Coast on last Friday, 2 3/4, 30-year fix. Okay, 2 3/4. You cannot complain about a rate like that. Even if rates are at 3 or 3 1/8 or 3 1/4, rates are still very good. But as an industry, rates aren't really the issue right now. The issue is more refi burnout. Boy, I just refinanced, the Smith family, in September at 2 3/4, and I'll never see them again. Well, I'm seeing a lot of brokers and a lot of lenders out there saying, well, hey, Smith family, look at the appreciation you've seen in your house over the last few years. Don't you have a need for some of that cash? So the industry is starting to shift a little bit towards cash out refis, but also towards purchases. And I know inventory is a problem across the industry, something we're all dealing with as an industry. But people still want to buy homes. People still want to buy homes no matter what interest rates are. And sure, there's an affordability issue, and sure, you can talk about the lack of inventory, but they still want to own homes. And Linda, you might remember, for years we were sitting here scratching our heads saying, oh my gosh, are the millennials going to buy houses? Are they going to get married? Are they going to have kids? Do they want to own dogs? Well, yeah, they want to do all of that. And with 70 plus million millennials out there in their late 20s and in their 30s, and a lot of them don't own homes. And I'll tell you this, with builders building about 1 to 2 million units a year, that's not a lot of supply to soak up the demand. So inventory, I think, is going to continue to be an issue in many parts of the nation. And I've talked to a handful of people just in the last few weeks who are down in Florida shopping for second homes or looking to move out of Manhattan, out of New York. So Florida should continue to be just fine value-wise. So getting back to my earlier statements about we as an industry and brokers especially dealing with all these global issues, and at the same time dealing with micro issues about loan programs and interest rates and so forth and so on. There's a lot going on. There's always a lot going on, which is why I'm a firm believer about why originators human originators, not the internet, will continue to do well into the future. When you talk to a real estate agent and you ask them, what do you do if you have a client who's asking about a home loan? That real estate agent will never tell that borrower, just type in mortgage on the internet in a search engine and they'll take care of you. It's always, you need to talk to Pat. You need to talk to Linda. You need to talk to Danny. Whoever it is, you need to talk to them, and there's a warm handoff because that realtor trusts you. We're in this people to people business. So I'll finish off with that I don't see us, certainly the internet has added complications and internet lending has taken a piece of the business, but I still see brokers and individual originators continuing to thrive into the future. So Linda, with that, I'll stop and,
Okay.
What would you like to talk about now?
All right.
I touched on everything.
I've got a few things here. I don't think we're going to run out of topics here. So do you feel like that the broker, when you were talking about the broker community, so you feel like that we're still very close knit and that we have an advantage in the market today?
I think that some brokers have advantages and others don't.
Okay.
What's that?
I said, okay, that's fair enough.
So it's interesting, the last few weeks, and I'll do it later this week and again next week. I sit in on these MBA Strathmore peer group meetings where you put Rocket and Freedom and Plaza and Loan Depot representatives in one room, and you talk about performance, and you talk about, does this work or does that work? I mean, there's no collusion, but it's just professionals comparing notes. And I see how when people are good, hard workers, consistent, dedicated, knowledgeable, you can go down the list of personal attributes, they will be good at wholesale, they'll be good at retail, they'll be good at correspondent, they'll be good at direct to consumer, they'll be good at whatever they set their minds to. Same thing happens in the broker channel. You have good brokers and you have bad brokers. There are probably brokers out there who are happy taking an application, quote unquote, on a yellow legal pad and then passing it off to their processor to take care of all the dirty work, as it were. You have other brokers who have embraced technology and they keep abreast of the technological changes that are going on out there and the tools that are available out there and the wholesale investor landscape and who's doing what products. I get emails all the time about people pretend that I'm their deal desk, and they'll write and they'll say, well, Rob, I've got this yurt in Wyoming on 30 acres, might be in a floodplain. Do you know a wholesale investor who will buy, I can price that too, I can originate to. And I always refer them to this site, www.mortgageelements.com. And mortgageelements.com is just an example, a tiny example of the technology that's available. So there is in effect, at www.mortgageelements.com, this ready-made deal desk that any broker in the nation can use, and you type in your state, and then you look at all this list of programs and you click on a certain program, non-QM or condo, high-rise condos or whatever it might be, and up pop all these wholesalers that offer that program. So that's just one example of technology that is free and that you can use and to give you a leg up on your competition and to give you a leg up on somebody sitting there at a Chase branch or a B of A branch who is tied into the Chase or the B of A programs. I mean, you have this wide range of potential outlets for your programs, and brokers who recognize that and who are able to use their competitive advantages to their advantage will succeed. So it is a close-knit community, because a lot of the problems that brokers face in Reno, Nevada might be the same as the ones faced by brokers in, Minneapolis or in Fort Myers. And so organizations like this are good sounding boards, are good networks for brokers to compare notes and say, hey, have you heard about this site? Or have you heard about that? Or, hey, have you heard about this this free commentary that this guy on the West Coast puts out every morning at, around 8:45 a.m. or whatever it might be. It's a good thing to do that. I will say that brokers who kind of ignore the technology, who ignore the tools that are available to them, who only deliver to one wholesale investor, they probably are at a bit of a disadvantage compared to others. So it's just a matter of the people kind of doing their job and doing it well and helping their clients. I think they'll succeed.
Right. Well, let me ask you, let me share with you some information about our licensed originators here in Florida. We are experiencing record number of loan originator applications, and FAMP has a great relationship with the OFR, the Office of the Financial Regulation. So we're able to obtain these updates pretty regularly. And we met with them in Tallahassee last month. And there are 1,500 a month to 2,000 a month since probably about October, in the early fall of last year, of new loan originator applications. So we're experiencing, again, record number. Do you see any of that across the country as you're talking with people in various states? Do you see licensees applications increasing all over for loan originators?
Yes and no.
Okay.
Two things I'm seeing out there. The first is a lack of people in their 20s and 30s getting into our business, which point. Is, what's that?
I said that's a very good point.
Yeah, I don't see young people entering our business. I would say that young people barely know of our existence. And what they may know was that, my parents got foreclosed on 12 years ago, and the mortgage people are evil, and who'd want to do something like that? And they don't realize what a great industry we're in, because we help borrowers every day. So there's not a lot of young people, and the young people who tend to go into our industry tend to do it because of word of mouth. So there is that going on around the nation, kids of people already in the industry getting into the industry. I think that's part of it, or friends of kids and so forth. There's this referral network, like, hey, what'd you do this summer? Oh, I worked at my uncle's mortgage brokerage. Well, what do you mean? What's a mortgage brokerage? How does a mortgage work? What did you do? Well, I did this. So that sounds pretty cool. Yeah, we had a softball team, we had potlucks, and blah 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 blah. It's a good lifestyle. So there's this referral thing going on. But to your point, there's that going on, which is limiting. But what isn't limiting, frankly, is the efforts made by some of the large wholesalers to convince originators to move from being just an originator at pick a place, Wells Fargo or Fairway or wherever, and start your own brokerage.
Right.
Why don't you? Right. You're originating loans for Chase. You've been there 12 years. You're starting to get tired. You see other products you'd like to offer. You're tired of the bank. You're tired of the bank environment. Come be a broker. Mm-hmm. Go off on your own. Get your own license. And so I am seeing that around the nation as well. So I think the large wholesalers have done a very good job of attracting companies, or I should say individuals, to start their own broker shops or to go off on their own and work for a broker, whatever it might be. So that's definitely out there. Now, will it continue? I remain to be convinced. We'll see how far that effort goes. But I think it's a good effort, especially if it's replacing or adding to the staff of an aging broker population. If they can get new people in their 20s or 30s or 40s or even 50s into the broker world, then good.
Yeah, you just kind of gave me an idea that we should be, what we should be doing as a trade association, and probably help develop that with our industry partners and our brokers, is an internship program. Because I was actually just having lunch with someone today, and they were talking about their 21-year-old daughters kind of struggling to find that that internship program that she really wants to be in, but getting rejected and so forth. That's what we do not have in our industry. And that's how we get those 20-year-olds and those 20, you know, those younger, potentially, you know, professionals that are being educated right now. So maybe that's something that we can talk about further sometime, because that's what we should be doing. They're not just, as you said, their only knowledge of a mortgage is maybe their parents getting foreclosed on a few years ago.
Yeah.
So that was an excellent comment.
When you start having in-person meetings again,
Right.
you know, one thing I've seen organizations do is go around the room, especially if there's not, you know, 400 people in the room, but if it's relatively modest sized, and people stand up and say, you know, with 1 or 2 or 3 sentences, don't make it a dissertation, but how they got into the business.
Right.
And when I've seen that done, you know, the majority of people, it's my mother, my uncle, my aunt, my cousin, I mean, my friend. It's that kind of stuff. It's not, I saw an ad, or, you know, I went to school to be an underwriter, that kind of thing. It is a referral business.
Right, exactly. All right, I have a question for you on kind of the hot topic right now. There seems to be some confusion going on with the new QM definition centered around the decision by the CFPB to postpone the new QM definition. Could you help us kind of understand what's going on there?
Sure. I'll QM for dummies. Well, I consider myself a dummy when it comes to some of these things, especially when you get into the weeds. But if you remember way back when, there was prime and subprime, and then we had the financial crisis, Great Recession, whatever you want to call it. And you know, subprime became a dirty word, and stated income, stated asset, and all those programs went away. And lo and behold, the CFPB was created out of the Dodd-Frank legislation, and in that period of time, we did away with prime and subprime and created QM and non-QM. And initially, seems for years, and even to this day, I think some people think, oh, non-QM is the same as subprime, which it isn't.
Right.
There are certain criteria that loans go into the non-QM bucket. The largest of which, well, I should say, when this was coming out, the agencies and the regulators and so forth came to an agreement and created this QM patch, which basically said if a loan, even though the debt to income ratio, and when you talk to originators, by the way, Linda, as you probably know, I mean, the debt to income of 43, I mean, that's kind of a line in the sand. How do they pick 43? Why not 42? Why not 44? But that line in the sand, that debt to income ratio of 43%, okay, even if it's above that, if it sails through DU or LP, then the agencies will buy that, and we will call that the QM patch. And it's a temporary patch, just like you get on a bike tire. You know, you want a new tube really in your tire, but if you get a flat, you might put a patch on it for the time being until you can get to a bike shop, because a patch is exactly that, it's a patch. So the CFPB has always had this in the background. It's like, okay, what are we going to do here? What are we going to, can we make it more legitimate other than just 43% DTI? Right. And so the CFPB, to their credit, in the last few years, worked with the industry in terms of establishing new rules for QM versus non-QM. So that has been delayed a little bit because it is a relatively big change. But what has happened with Fannie Mae and Freddie Mac through the FHFA said at the end of last year, and then reminded everybody recently, is that as of in July of this year, the agencies are going to stop buying loans under that program, which basically means that if you have a 44% DTI loan, even though it goes through DU or LP, you're going to have to find another outlet because Fannie Mae and Freddie Mac won't buy those loans. And that kind of thing comes back to Calabria shrinking the footprint. Now, I need to add a quick note about Calabria. because we're reminded of this constantly, that the Supreme Court is considering this weighing in on a case which, through its ramifications, might mean that the Biden administration could ask Mark Calabria to leave, in which case the Biden administration, my guess is, would put somebody into that position who would be much more user-friendly, shall we say, for the industry. But nobody, the CEOs and so forth, the owners of lenders I talk to, they aren't banking on that decision, and they're not banking on Mark Calabria leaving, even though it might be as soon as this summer, and the year seems to be rushing by pretty quickly. But the leadership of the FHFA may change, in which case some of these things might be reversed. I know that, for example, the FHFA is taking a look at the adverse market fee with regard to refis and the 0.5 point. And they say in October, we're going to do a review, and in December, we'll have a decision about that 0.5 point. So that's actually a little bit of good news. But there hasn't been much good news that's come out of the FHFA for quite some time now. Mm-hmm. And I will, everybody will say that that's Mark Calabria's responsibility. And so getting back to this QM patch, yeah, you can look for the agencies to go back to the 43% DTI and DU or LP be damned kind of thing. That's what they're going to do.
So is July 1st? I'm hearing that the July 1st is that they're not, Fannie and Freddie not buying loans after that date. Is that what you're hearing as well?
Yes.
Okay. So what do you think that what type of loans will they buy after July 1st? Just the ones at 43 and below? Yep. So it
that's
seems
what
like,
I've heard.
Yeah. There's a lot of opportunity for those non-QM lenders out there, right?
Oh, they are licking their chops.
Yeah.
They're licking their chops about that. They're licking their chops about the non-owner occupied and second home cap of 7%. Fannie Mae and Freddie Mac buying those loans. So then, once again, as an industry, people, brokers, mortgage banks, credit unions, so forth, are left scrambling a little bit, trying to find outlets and establish relationships for institutions that will pick up the second homes and the non-owner occupied loans, and loans above 43% DTI.
What do you think that percentage of business will be an increase for the non-GM lenders? Do you see, is there any type of predictions of what their volume will do?
No, non-QM lenders, non-QM companies, the Deep Havens, whoever you want to Sprout, they've been talking a good game for a while now, for some years now. And they, as an industry, it never seems to do more than 2 or 3 or 4% of the total business. Obviously, 2020 was a very unusual year. There was so much business coming in that was just kind of cookie cutter, wave it on in, DULP, low debt to income ratios, great credit, and so forth, that the industry didn't really need a non-QM outlet for a lot of the loans that they were doing. I mean, do you want to bog yourself down with maybe one non-QM loan, or do 3 or 4 cookie cutter loans? Sure, you're going to do the 3 or 4 loans. But now, with volumes diminishing a little bit overall and margins changing, and the changes that FHFA have implemented, I think a lot of the non-QM investors are indeed seeing this as a year that they should do pretty well in.
Right. It'll probably, you've used the word cookie cutter. That may be the new cookie cutter in the non-QM market, as far as anything over 43, that becomes that. So let's talk about, with the GSEs, what they will purchase. We see that they, of course, have the limit to the 7% of their portfolio of the second homes and investor homes. Can you explain why these rules came to be? Kind of give your interpretation on that.
Yeah, it's a Once again, it's Director Calabria's interpretation of where Fannie Mae and Freddie Mac should be and what their charters say they should be, and with an eye on getting them out of conservatorship. So interestingly enough, when you look at the production that Fannie Mae and Freddie Mac buy, and I know Florida is different, which we'll get to in a minute here, but nationwide, industry-wide, they tend to buy about 8 or 9 or 10%, 8 or 9 or 10% of what Fannie Mae and Freddie Mac buy are non-owner or second homes.
Mm-hmm.
So a cap of 7% isn't onerous. The question came up yesterday with his presentation, why didn't you just price it accordingly?
Right.
Why don't you throw a 5-point hit on second homes and non-owner occupied loans and call it a day and forget this cap stuff, because the cap stuff really messes up in originators, mortgage companies, like, 7%. Why not just put a price on there? And Calabria said it was at the Treasury's insistence in January regarding these amendments. It was at Treasury's insistence that they cap it at 7%, because the Treasury viewed a higher number as increasing the risk of Fannie Mae and Freddie Mac. And given the capital that Fannie and Freddie have, if we do get into a downturn, they won't have sufficient capital to stand behind their portfolio. And especially when push comes to shove, the historical performance of non-owner loans and second home loans isn't as good as primary mortgages. And so the Treasury Department said, let's cap it at 7%. Mm-hmm. Now, Calabria did say that more amendments might be forthcoming. They're going to take a look at some things, but given historically what he has done with regard to Fannie Mae and Freddie Mac's footprint, I don't see a lot of, hope isn't a strategy. And so, hoping for something isn't going to get us there. Now, I know that Florida is a different market. Arizona, to some extent, is a different market when it comes to second homes and non-owner occupied loans. And unfortunately, Florida does get lumped in with the rest of the nation in terms of the caps. And so a lot of the non-owner occupied loans that may come out of Florida tend to offset loans that come from other parts of the nation that are primarily primary residence loans. But I don't see them doing anything. And the main reason, as I said, why they did this is because of the risk profile and their financial situation and where Calabria thinks they want to be as time goes by.
Okay. So
it's not the industry doesn't like it. No. The industry doesn't like the implementation of it. I know the MBA is trying to figure out if anything can be done, but at this point, it's kind of, grin and bear it, unfortunately.
Right. So does that impact or will continue to impact our volume and margins, you believe?
Yes, that's a good question. I don't know the answer to that. I don't know. A lot of people who I shouldn't even, I generally, what comes to mind is many people who are buying second homes or investment properties may not even get financing. A portion of those may be cash. This change, the pricing due to this change, because a lot of companies right away put 2 or 3 point price hits on their programs. Those changes may have driven people to use use cash to buy places, right. Or it may have driven them to say, you know what, I don't need that rental after all, in which case it filters down to tenants, which but oftentimes are minorities or hourly workers. And so that has a negative impact on them. And I think that what the Treasury, I think that's the angle that the MBA is working, is to say, this change that you've made impacts the lowest rung in many cases of our economy, and that's not what we want to do in this economic climate. They've been hit hard enough because of the pandemic, and now you throw this at us. Let's figure something else out.
Well, again, another opportunity that's existing now, I think will continue to exist with the non-QM lenders, really maybe hopefully aggressively pricing at least the second homes. Investments they've always done, and that's the price you pay when you originate investor homes. But maybe we'll see some more of that in the non-QM, that they're second home loans, especially in Florida, are pretty low risk. They're A paper loans, so I'd like to see that. So how about companies going public or merging? Do you see any, you've got any news out there about that happening, or what are your predictions with that?
You haven't had enough in the last 6 months. You want more?
Yeah, we want more.
So I had the opportunity to interview Angelo Mazzillo from Countrywide a couple times in the last few years, and then we got along well. And he, he's a smart guy. Say what you will about what direction Countrywide took, or the managers of Countrywide took, but decent enough guy. So Angelo, I asked him, what was the biggest mistake he ever made when he was at the helm of Countrywide, and he said going public. Going public was the worst thing he ever did. And I said, why? He said, because when you have your own company, or your family owns a company, or the employees own a company, the responsibility of reporting and decision making is relatively limited. If you own your own company, if you own your own broker shop, the decisions you make are the decisions you make. When you're a public company and you've got stockholders who are your owners, and you've got analysts who are looking over your shoulder, and on top of that, you've got Congress, and you've got regulators, and you've got every state in the United States trying to make a name for themselves by pointing out the bad things that a given lender is doing. He said it was a nightmare. He just didn't need that kind of scrutiny by going public. Well, what we've seen in the last 6 months or so is a different kind of going public. And it's not so much necessarily at the CEO's decision, it's been more the investor's decision. So when you look at the companies that have gone public and who owned them, basically venture capital funds or hedge companies, whatever it might be, private equity, if you talk to somebody in private equity, they want to double their money overnight. And if they can't double their money, or it's taking longer than overnight, they still want to get out with a return as soon as possible. And as 2020 went on, these companies, these individuals said, we've had a great year. We've made a lot of money. This could be the high point of the industry. So let's sell and let's take some chips off the table. And so these companies have gone public, not because they're going to take the money and invest in a new LOS, or they want to invest into direct to consumer, but it's because their owners, which typically are Wall Street companies, wanted to get a return on their money. Well, a lot of that's died down. When you look at the investors and the large mortgage companies that are out there now, some of their owners are just individuals, or are families, or are employees. So they don't have that need to cash out. When you talk to the owner of a mortgage bank or a mortgage broker shop, they're in it for the long term. Their time horizon is very lengthy. It's not quarter by quarter by quarter that analysts and shareholders want to know, like, oh, if you're going to get a new LOS, how long will that take to pay for it? Sure, that's a consideration if you're a one-person shop, but it's not as big a consideration because you want to keep doing this business. You want to maybe hand it off to your kids. And so the companies that have gone public did so for a reason. It's mainly to cash their venture capital owners out, and who are left is it maybe a different group. Now, that's not to say that we're not going to see a lot of M&A going forward. And in fact, I was talking to Garth Graham at the Stratmore Group the day before yesterday, and he said, Stratmore, and he's heard through the grapevine, a lot of companies are looking to merge or be acquired, some name brand companies. So I expect that to continue. I think the M&A business will continue to see headlines like Caliber, New Res, Stearns, that kind of stuff, companies stepping in, buying lenders. But I don't necessarily see the public offering going forward as we've seen in the last 6 or 8 months.
Okay. So do you see possibly brokers being replaced by the internet then? I mean, do you? No? Good.
Brokers replaced by the internet? Now, it goes back to what I was saying earlier, that when, if you look at the broker business model, they are, for the most part, good business people, smart, they're very nimble. They like being able to present a variety of options to borrowers. They like the communities that they serve. They've often been there for years and years and years. They know the realtors, they know the financial planners, they've got the referral basis. The internet really doesn't have, a referral basis. I thought about a couple of years ago having a T-shirt printed up saying the internet has never gone to a loan closing. And in fact, I don't want to see anybody on this call take that and run with it. It's still out there. I'm just trying to find a T-shirt printing company, but I think that there's some truth in that. It's the customer service. And you look at 2020 and what was going on and all the uncertainty we had with the pandemic and the health situation and states being closed, counties being open. I mean, all this going on out there. And really, if you were a borrower, you relied on your loan originator. If you were refinancing or buying a place, you wanted somebody to talk to. Sure, you could go on the internet and type in, what's an escrow account,
right?
But holding their hands. I bet everybody on this call has stories of borrowers who, probably cried at the closing, or just talked about, sent letters about how much they valued the services of brokers throughout 2020 because of that personal interaction. They just like talking.
Right.
So,
I asked that question because there are so many with the millennials and the Gen X and so forth. Everyone communicates, of course, electronically, and they do not seem to need the warm and fuzzy approach, but they really still need the verbal explanation. I think they really still need that person, knowing that there's that one person that's working on their behalf. And so that's encouraging. It's nice to hear you say that, because as I experience, I have, you're getting old when you're doing mortgages for your youngest daughter's friends now. And I've experienced that here lately, and they do need a lot of hand holding. They'll do everything. You don't have to talk to them too much, but when they need you, they need you. So
exactly. I think a good broker, earlier I was talking about technology. A good broker knows how to communicate with the borrowers. Is it text? Is it email? Is it passenger pigeon? Is it, phone call? How best to communicate? And when you're dealing with a loan on the internet, you don't really have options like that.
Right. Yeah. No, exactly. Okay. So we have a few more minutes. So do you mind a couple more questions here?
No.
Okay. All right. So let's turn to Capitol Hill. What real estate and housing policy do you see popping up in legislation, or do you see any?
It's all it's based around affordable housing.
Yep.
And it's based around, when you look at the CFPB and the direction it's taking, very consumer oriented, not industry oriented. The Biden administration has made it clear, the administration had on Joe Biden's pre-election webpage, housing was a bullet point. You click on housing and up popped all these things you want to do. Donald Trump didn't view housing as that big of a deal. So now we're dealing with those bullet points that he had, and a lot of them had to do with affordable housing. A lot of them had to do with first-time home buyers, minority home ownership, and so forth. And that's it's tough to forward that agenda in many cases. But we've seen some things pop up along those lines, but it's tough. There is this disconnect between the federal government saying, well, we want home ownership at 70%, and telling the county, that you're in, or a bunch of neighbors that are near a vacant piece of land that's 3 acres, and somebody wants to put affordable housing in there, and you've got the neighbors saying, well, not in my backyard, or the county saying, well, it's not zoned like that. So there's oftentimes, or it's very expensive. The federal government doesn't set the cost of lumber. It can't set the market price of a skilled carpenter. It can't deal with some of the supply chain issues of getting, faucets and toilets or door hinges. So there's a lot of complicating factors between the federal government saying one thing, we need more affordable housing, and actually have it filtered down and happen. So it'll be interesting to see that. But yeah, the Biden administration, primarily first-time home buyers, minorities, yo hablo español, and affordable housing.
Well, they're going to have to cut off those stimulus and unemployment checks, because I don't think we can count those in the gross monthly income.
Yes.
So people are going to have real jobs in order to afford housing. And that's probably a challenge that we're going to see moving forward. I've heard some discussion of the federal government creating their own credit bureau. Is that something you've heard of, or?
That popped up in one of Joe Biden's early speeches, I think. I've heard nothing since about it. It caused a little bit of flurry of excitement, say, the government really shouldn't be in there doing that. That's not their purview. But I haven't heard much about it since. I think there are bigger fish to fry, like immigration, healthcare, and some of the civil issues that are going on in the United States, and not creating a federal government credit bureau.
Okay. And just 2 more questions here. As we see, around the country with the housing inventory being such a challenge, we're seeing, especially in Florida, a lot of, new growth, new construction, new developments that's going on. And I believe that's probably all over the country. Do you see, we as brokers always have a challenge with, builder-owned mortgage companies and trying to compete with that. Do you see that that those type of builder-owned mortgage companies are going to remain intact, aggressive, and continue to operate the way that they're operating?
Yeah.
Okay.
Sorry. Yeah, I haven't seen one bit of anything that would suggest otherwise.
Right. Okay. So we're at 3 o'clock, but I have one final question for you. How long does it take you to write your daily your daily news to us?
I've got days and days and days worth of material. It's just a matter of what I think is important and what I'm getting a lot of emails on and trying to address those topics. And but it takes 4 or 5 hours a day. People think I sit on the porch and drink umbrella drinks all day and kind of get a suntan and just kind of hang out and watch, reruns of Mad Men or something. But no, it's, I'm on my computer a fair amount. And the good thing is there's so many neat people in this industry, Linda, that I interact with them either on the phone or on the computer. And so it's rarely dull. It's rarely like, oh, I gotta, get up at 4 a.m. here on the West Coast and trudge down the hall and turn on my computer. It's usually, what's going to happen that day, or what all's going on out there. So it's never boring.
That's good. Well, you've been a wonderful supporter, and a huge informational outlet for our industry, and wonderful supporter to FAMP, and we really do appreciate that. We appreciate your time today, and hopefully I can talk you into, I'll send you the dates on our convention. Maybe I can talk you into coming to Florida. So, and speaking to us in person, if you're open to that. Not to put you on the spot, but I'm putting you on the spot.
I have no qualms about in-person events. I'll actually get my second shot on Saturday, but I don't know if that'll really change my life too much. But I'm looking forward to it, and yeah, I definitely see some green shoots in the conference arena popping up in terms of in-person events.
They're
so
great.
Congratulations on that.
Thank you. Thank you. You know, last year we put ours on, and it was a limited attendance, but you were very kind to us by mentioning that in your daily information. So we really appreciate that. So any parting words of wisdom before we adjourn here?
No, just keep helping consumers.
Yep. Okay, well, that's a good one. Thank you all for attending today. Thank you for supporting your FAMP. We thank you for your membership, and if you're not a member, we really hope that you become one. And Rob, we'll see you again soon. Thank you so much. All right.
Thanks for having me.
Bye-bye.